Hi, my name is Stuart and welcome to the Investopoly podcast. My goal is to share easy to understand evidence-based holistic insights to help you master the game of building wealth. And before we get started, I forgot to mention last week that tomorrow I'm hosting a live session on YouTube, and it's about lending, borrowing. I don't know if the right term is to call it, I'm a borrower, but, lending. Anyway, it's about finance and related to property. And my thesis is that finance is just as important as asset selection, because if you think about it, if you have unlimited access to finance, then you can build a substantial property portfolio. Of course, you need to think about the cash flow implications and so forth, but just theoretically. And so therefore, if you completely mess up your financing strategy, that's going to have a negative impact on your property strategy in terms of which properties you can buy, when you can buy the next property, upgrading the home, all those sorts of things. So anyway, that's what I'm going to talk about tomorrow, 20 minutes. At 12:30 tomorrow, live on YouTube. If you want to listen to that session, you can register. The link is in the show notes, and I hope you can join me there. Quick, fast information. Hopefully it works out well. Hopefully technology works out well. Fingers crossed. I hope to see you there tomorrow. Okay, so let's get into today's listener questions. As you can tell, my voice is a little bit better than the last week. Not perfect, but a little bit better. Okay, first question is from Ace. Ace wants a bit of a rundown on her situation, her and husband's situation, I guess their family situation. Gives me some fantastic feedback regarding the podcast, so I appreciate that. Okay, so she's 37, earning $92,000 with about 130 in super. Husband is 40, earning 122,000 with about 180 in super. The wife salary sacrifices to buying employer shares and also takes the bonus in employer shares. And that's just a tax effective way to buy shares. You almost always sort of participate in something like that. Question is whether you hold the shares. I'll come back to that. They've got 3 kids, 15, 12, and 10. Sounds busy. All in private schools, but they're thinking about moving out of the private school, which would free up around 30 grand a year for investing. Only 12,000 left on the mortgage, and the home is worth 950, but don't really see it as their forever home and would love to move into a more desirable suburb. So here's the question. I've heard you mention the importance of securing your forever home early. Could you please expand on why there's such a priority? Is it mainly about growth rates, or is there more to it? Given our ages and income, we can't invest heavily in all directions. So which direction should we go? Should we go and buy an investment property, upgrade later if possible, focus on building a share portfolio and super, or upgrade to our forever home sooner? So it's a really great question, and it's really easy to answer with some financial modeling, because you can show someone the numbers. And when I read this question, I thought, well, that might make a good YouTube presentation in terms of taking people through modeling scenarios, and so people can I talk about the concepts here in this podcast, but they kind of visualize it in a numerical format. Anyway, it's on the list. So in terms of upgrading the home, the issue is that if we don't do it today, that it's going to cost more to do it in the future. And that cost needs to be funded from after-tax dollars. So that is, we need to earn money, pay tax, and then repay the home loan associated with the cost of that funded the cost of the upgrade. And as a result of doing that, there's an opportunity cost associated with that. Because if, for example, ACE doesn't upgrade today, upgrade say in 10-ish years when they're in their early 50s, the issue would be at that point well, they would, in their early 50s, probably focusing a lot on super, or as much as you can on super. Makes a lot of sense. You're only 10 years away from being able to access it. So, the main negative with super, that is it's locked away and, you can't access it, is greatly reduced. But at that time, if they upgrade at that time, they're probably giving rise to a lot of non-tax deductible debt, especially if we assume that property values are going to increase over the next 10 years. And as a result of that upgrade, maybe repaying the debt will suck out all the cash flow, and they don't have any capacity to make other investments when it's kind of the perfect time in life to do so. Kids left home, hopefully, maybe. Income, has kind of maxed out typically in your career, and you don't have the expenses that a family creates, for instance. And, arguably in your 50s, you've got a lot of capacity to invest. But if all that capacity is going into just repaying debt, there's a huge opportunity cost associated with doing that. So it's a bit of a compounding impact. Whereas, for instance, if you reversed it and said, well, we'll do the upgrade today, in 10 years' time, because you're buying into a better suburb, your overall asset base is stronger. And you've also then got a lot of equity in your home. You don't have the handbrake of having a large amount of non-tax deductible debt. And so in your 50s, you could conceivably gear to a greater extent. Not only do you have good cash flow, but then you can use the equity in the home that the market has created for you in order to invest, whether that's in the share market or the property market. So it's chalk and cheese really when you compare or when you map this out from a financial projections perspective. So that's why generally I like to get the forever home as soon as possible. Notwithstanding, there's a whole bunch of lifestyle benefits of doing this, by the way, which, it's hard to put numbers on these things. Well, it's impossible to put numbers on these things, and that's not my job. It's my client's job it's my job to make informed financial decisions, and they need to overlay the lifestyle considerations. But it would be remiss of me not to mention them because they're quite significant, and you see it. You build a strategy. This is a strategy. This is what we should do, and it works on paper. It works in reality from a financial perspective, but sometimes the biggest outcome is the lifestyle. Being in a better location, being closer to family, being closer to more amenities, being closer to, good public school zones, for instance, all those sorts of things can have a really significant impact. I might just return to the salary sacrificing into shares. So just very quickly, I did a podcast on this not that long ago about employee shares, but essentially you have the option to salary sacrifice a small amount, $3,000 a year, I think, or something like that, into shares. So that means, your pre-tax income, you're using pre-tax income to buy stock. And then you can go and sell that stock. And, if you make a gain, of course, you're going to pay capital gains tax or income tax. But, it's a really tax effective way to buy stock. So you would always do it, almost always do it, I think, as a general rule. But the question is, do you want to hang on to that stock? Well, the thing, and I also spoke about this in that episode, is that you don't necessarily want to build, firstly, a large exposure in one particular stock. We know evidence-based share investing, diversification plays a really big role. So that doesn't make a lot of sense. And then secondly, you don't really want to hold a lot of investment dollars in a company and industry that is linked to your income. So still salary sacrifice and still do what you're doing, but just think carefully about gradually divesting of that stock and perhaps reinvesting in something that's more rules-based, like an ETF or something like that. Now, that's a really long preamble. Hopefully everyone gets the benefit of, that insight or that view. But let's return back to Ace's question. What would I do? Income's 92, or about 200,000, or just like 210 of family income. So the income's quite good. I guess what I would do is going to depend on your school fees or private school, public school decision. There's a huge opportunity cost there. That's all your surplus cash flow pretty much. So, from a financial perspective, there's a huge opportunity cost. That's not something that I'm going to weigh into because it's a very personal decision in terms of how you want to educate your children. But, my role is to help people make informed decisions. There's a huge opportunity cost. You've got no debt against your home at the moment. Could you go out and buy that forever home and then put a tenant in it? That's probably not really going to work. I don't have the numbers, unfortunately, in this situation in terms of what that forever home looks like. Is it 1.5? Is it 2? How much debt would it take on? But certainly that would be the first point of contact, the first port of call, I think. The only thing I would think about, because your kids are 15, 12 and 10, and I know it might seem like, and particularly those with younger kids, that, life is going to be like this for forever. Actually, kids grow up very quickly in hindsight and, blink and 10 years will go past. So I guess the consideration here would be, would I upgrade to a home that's I need to think about what my needs will be over the next 10 and then 20 years. And it's quite possible that the second decade, my needs will change. And so just want to think carefully about that. Now, if you upgrading to an area that's going to be, an investment grade location and buying investment grade property, there's not a lot of downside to doing that. But I just think through that. And so if you said to me, though, Stuart, we want to be in this location, this is the house we're going to buy, we reckon we'll get at least 30 years there, then that would be my first port of call. That's what I'd really focus on. And that way you can sort of spend, your sort of 30s and 40s bedding that down. and then maybe mid 40s to 50s, then redirect your attention to investing, super, all those sorts of things. You still then have a long enough runway to sort of build those assets out, but at least, delaying the upgrade isn't going to have, as I say, a big opportunity cost later on. Thanks for your question. I hope that answers it, even though it might have been a very long-winded answer. Okay, next question. Gavin writes, listening to your podcast since 2018. Wow, that's been a bit of a ride. It's been like going to a barbecue with a mate who actually knows what he's talking about. Thank you sincerely for the content and the time and energy you put into it. I don't know what barbecues you go to, although I actually, you know what? In truth, that's absolutely bang on. If I go to a barbecue, my mates talk a lot of crap. So I hear you. Okay, so let's get into Gavin's questions anyway. And so Gavin's been through, looks like a relationship breakdown. So post-divorce, assets are a bit depleted. The home is worth 530 with 415 of debt. The investment property for which he runs his business from is worth 730 with 130 owing, but pays $2,000 a month rent. So it's obviously the business is picking up, so it's possibly geared. Only 100 grand in super. Ability to work is limited over the next 10 years because the kids are quite young. So his income's around $90,000. And to add a little bit of complexity there, he might need a larger house in the future, accommodate kids as they grow older. The other building on the strata title land, so it sounds like he owns one of two, is up for sale. If purchased, could purchase it for 450. It would allow me to own and control the full block. What would be my priorities if I was in his situation? And interestingly, Gavin says, I know you favour buying the primary place of residence as soon as possible. Well, Gavin, it's an interesting situation. I might have mentioned in the podcast previously, I went through a marital separation in 2012. It's a little bit of time ago now, but, I had to really start again from an asset-based perspective. So been there, done that, not an enjoyable situation necessarily to be in. Anyway, the thing is that, and I've thought about writing a blog about it actually for those people that, have been through something like that. But really, you need to prioritize rebuilding wealth. You didn't give me your age, so I don't know, how much sort of working time you've got left. But if your kids are young, I'm going to assume you're relatively young in your 30s, maybe 40s. But, if I was in your shoes, I'd really prioritize rebuilding your asset base and making some really difficult decisions, I guess. I know kids do need more space, but also kids do with what they're given, and they just need a safe place and loving parents and all those sorts of things. It's not really about room size. I know we'd like to give kids a better life and all those amenities, but it's not absolutely necessary. So I would, and this is not parenting advice of course, but I would prioritize my financial situation. So I'd probably, if you need more space, I'd probably rent vest, go and rent a larger home to accommodate the kids, particularly as they're growing, but really start thinking about, what's the best thing that I can do with my money. And, that includes trying to generate as much income as possible. I know there's a tension there between spending time with kids and being able to do that, but it's something you can think about. And, often, what's the saying? A great question's better than a great answer, or saying something along those lines. So just make sure you ask yourself really great questions. Like a really great question, if you're self-employed, is, how can I earn more money and more profit without working harder? And just focus on that question. Doesn't necessarily mean I need to increase my income. So, I need to work another 10 hours a week. That's not necessarily, that's the answer you're going to get if that's the question you're asking yourself. So anyway, that's what I'd focus on. And then I'd look at those two properties. You've got, what about 700,000 of debt against those two properties. And going back to return on borrowing capacity, which I spoke about a few weeks ago. Oh my God, it was back in September, episode 375. That's the only thing you can focus on at this stage, I reckon, Gavin, given your relatively tight income. It's really just about making sure, is that borrowing capacity working as hard as possible for me? And that might mean juggling some of those assets. Maybe if that asset isn't great to run your business from, so if that asset isn't otherwise great investment, maybe you're better off again renting for your business, renting a premises for your business, and selling those two properties and reallocating that borrowing capacity and equity somewhere else. So that's what I'd be thinking. I'd be prioritizing financial decisions. And actually, here is the reverse of my typical approach to get the forever home as soon as possible. You're not going to be able to do that unless you really build equity and increase your capacity. So I know there's an opportunity cost, but I would just be focused on, trying to maximize returns over the medium term, getting that money working hard for you. And then once the kids are a little bit older and you've got a little bit more flexibility, you can increase your income. That's when you can start thinking about the home upgrade. Anyway, good luck with it, Gavin. I know it's a difficult situation, so all the best with it. Okay, next one is from Kieran. Kieran's situation, I'm just going to paraphrase because it's quite a long. Firstly, Kieran gives me some great feedback, so thank you very much. I'm not overlooking that. But I just paraphrase because it's quite a long sort of situation. Essentially, Kieran and his wife are married, two young children. They're renting at the moment, but they have got an investment property which they used to live in. So they're using the 6-year rule, main residence exemption 6-year rule on that property. The property is worth 660 and they owe about 320 on it. So they've got quite a bit of equity in it, and it's an apartment near Glenelg Beach in Adelaide, of course, that was built in 22. And they want to buy their forever home when he graduates as a physiotherapist. I don't know when that will happen. Anyway, in the future. And there's really three options. They can refinance and pull out equity up to 90% against the existing property, which is currently an investment property that obviously they don't pay capital gains tax on. So they get to keep the property, borrow 90% without mortgage insurance because ANZ will do that for physios. And they get to keep the property, or they could sell the investment property, and that will actually enable them to spend more on the house, the upgrade. Although the downside then is that they don't have an investment property anymore. Or they could cross-collateralize and use the equity in their investment property and borrow 100%, of the home, because they don't have any cash to obviously put the cash into the loan itself or whatever they've done with their cash. Or maybe they haven't had a lot of cash savings, who knows. Anyway, and he's asked me, what do I think about that strategy? So, firstly, it's not worth cross-collateralizing. It doesn't actually extend your borrowing capacity. If it depends on the loan to value ratio, right? If you're borrowing 90% of one asset and 90% of the other, it doesn't matter if you split that into two loans, two individual loans secured individually by the relevant property, or put it into one loan. It doesn't change your borrowing capacity. So you'd never cross-collateralize. And for those people, and so cross-collateralization, by the way, is where you have a loan that's secured by more than one property. It's okay to have multiple loans against one property, but it's not good to have multiple properties against one loan because it sort of locks you in and you lose your flexibility. I've written about it before. Check out the blog on the website. If you Google cross-collateralization, it'll come up. So there's never a good reason to cross-collateralize. So we can just sort of cut that one out to begin with. And for those that, have to pay mortgage insurance if they borrow more than 80 or 85%, you want to be careful about how you secure your loans as well, because that can influence the mortgage insurance premium. So again, a good broker is going to be able to sort of work you through that. And if you've got to pay for mortgage insurance, that's one of the main considerations in terms of which lender you use, because the insurance premiums can change significantly. So the interest rates neither here nor there in those situations. It's the overall cost more guided by mortgage insurance cost. But I just wanted to mention that just for people that aren't in Kieran's exact situation. The thing that I'd be thinking about in Adelaide is the cycle. Now, in episode 370, back in August this year, I talked about long-term property data. And when you look at the long-term median house growth rate in Adelaide over the last 10 years, it's the highest of any capital city. Doesn't make sense, right? Because Adelaide is a relatively small city relative to really the eastern capital cities, being Melbourne, Sydney, and Brisbane. And we know and we can observe very clearly, actually, and then when you look over 20 years, it's the second highest, just slightly behind Sydney. Again, that doesn't make a whole lot of sense. So that's the first thing that kind of jumps out at me with your question, Kieran, is that if you go and upgrade and then put all your eggs in one basket, sell the property or keep the investment property, but either way, you've got property in Adelaide, what's that going to do from a future wealth perspective? Now, of course, markets, I'm not saying it's end of the growth cycle, but you look at the numbers, you would say it's fully valued and it could experience, or when you look at history, it's going to experience a flat cycle of 7 to 10 years. So that's just something that's not really helpful information for you, but that's just something that I'd be thinking about. And I guess as a result, I would be more conservative with this decision given where the cycle is at. And I would probably hedge my bets. Well, the thing is, though, and when I say hedge my bets, I'd probably prefer to keep the existing property, pull the equity out, and go buy a family home. And that way, I've got sort of two property assets in a market that might be a little bit overcooked, in the hope that I get some geographical diversification. And if the property that I buy for a home doesn't move for the next 10 years, well, hopefully the investment property does a little bit better than that. That's kind of the thinking, but I don't know the exact properties. I don't know, their attributes, their likelihood of growth, how they compare quality wise, where you're going to buy a family home, all those sorts of things. That's going to come into it. And this is really where it's not a science, it's more of an art. And this is where I talk about, buyers agents and getting property advice and so forth. This is where, you really need someone that's sort of local on the ground to make this sort of very subjective assessment of, am I better off owning two properties, or should I put all my eggs in one basket? It's a bit difficult to answer, but that's the thing that I'd be really conscious of in a market that wasn't at that price point. Sorry, at that point in the cycle. So, for example, if I was talking about Melbourne, I'd almost certainly say sell the investment property, maximize your budget. Therefore, you can in terms of budget for the home purchase, forever home purchase. And that way you're going to get a better quality asset, and you're going to buy at a point in the market that it's relatively cheap. That's what I do in Melbourne. But in Adelaide, I'm really concerned about it. And the thing is that if you do what you want to do and it gives rise to a relatively high amount of debt relative to your income, and the asset value doesn't move, you'll feel like you're treading water for a very long period of time. So I know that's not particularly helpful. If we were having this conversation maybe 10 years ago and we had a crystal ball, of course you'd go hell for leather, because prices have increased so much in Adelaide over that time. But unfortunately, you're sort of arguably towards the end of that growth cycle, and that's kind of the financial risk of really focusing on your home upgrade. Really interesting episode today, because we've had kind of three questions. One where I've gone, yeah, upgrade the home. One where I've said no, and another, there's a lot of nuance, I guess, and that's why I sort of enjoy doing these Q&As, because it does actually show that there's a lot of nuance, and answering a lot of these questions, whilst they might have some similarities, they're all different. And I guess it does sort of showcase that there is a lot of nuance in financial advice and building a strategy. Anyway, Kieran, good luck with it all. Hopefully that commentary, although not preferred, but hopefully a commentary helps. Okay, changing speeds now. Next question is from a person that wants to remain anonymous. Firstly, I want to personally thank you for the service you provide. You're a unicorn of financial planning. I've engaged accountants and financial planners separately, so it's been refreshing to listen to your knowledge, which combines both in such a professional manner. So thank you very much. And the reason that I read out that positive feedback was really just to reiterate, there's a lot of decisions are so multifaceted. I'd throw mortgage broking in there as well, insurance advice. There's a bit of estate planning in there. So there's a lot involved. And, I strongly believe we should define ourselves as all financial advisors. Ultimately, it's just financial advice is kind of one umbrella that covers the whole lot. That's how we look at it internally in our business. Whether I'm doing your tax return or helping you apply for a loan, it's all got to go. It's all a means to an ends, of course. And, the fact that we classify ourselves as an accountants, as planners, as mortgage brokers is really just aligned to what our specialization is, but it's a subset of really building wealth. So, and I'm glad that I can kind of, again, showcase this in these sorts of Q&A, because it really sort of comes out. Okay, so a bit about this listener. This listener, stockbroker, always been worried about the longevity of his career, so would love to be in a position where he can retire earlier. In the early 40s, him and his wife in early 40s have two kids under 10, own the house with no debt, worth about 3.5. I'm going to guess they're in Sydney, on a really large block of land, which they could subdivide but don't really want to. In terms of assets, 600,000 of super combined, 200,000 in managed funds, and 900,000 in an investment company that they manage. I did this in investment company as I didn't have anywhere to distribute income to, as we're both already in the highest tax brackets and can't distribute to kids as they'd be taxed at a too high a rate. Started my FIRE journey journey. So that's financial independence, retire early. 2 years ago, I didn't invest in super as I can't touch it until I'm 60. So that's 20 years away. As I mentioned, I want to retire early. I'm thinking of retiring in the next 5 to 10 years. My query would be, would you do anything differently? Would you change the structure, my investment structure? I'm hesitant to invest in property as I've learned it's not as effective as super, thanks to you. And if I want to retire early, there'll be no negative gearing in the long run. I'm more than happy just to invest in shares and ETFs, but am I doing it the right way? Okay, awesome question. Look, I wouldn't invest in property in your situation. If you want to have the flexibility to retire in 5 to 10 years, then buying a negatively geared property is actually only going to make that harder, not easier. Although it might build a lot of compounding wealth, over the next 20 or 30 years, it's not going to help you hit your goals. Really, what you want leading into retirement is no assets generating a negative cash flow. So that is at a portfolio level. You want the assets washing their own face. They don't need to be generating income, a large amount of income, but just not costing you money, and liquidity. And that's the issue with property is it's a liquid. Where with shares, even if I'm getting 90,000 of share income, but I need 110 to live, I can sell $20,000 of shares each year, and I can kind of work through the capital gains tax consequences of that. Like it's not going to be that huge. Whereas with property, you can't do that. So you need liquidity and you don't need negative gearing. So no to property, 100% no to property. In respect to your situation, I hear you in terms of not being able to distribute to kids, but typically, and it just depends on how you're earning your income, and I'm going to assume you're PAYG, or a lot of it is personal services income, so it's coming into your personal name. In that situation, what we would do is we would invest in a trust, but then have a corporate trustee. So I hear you in terms of, I'm going to put it in this entity because, I can't distribute to the kids, at least not yet. And so I'm going to put it into this entity. The problem with investing in a company directly is its shareholding. And its shareholding is fixed. So whoever owns the shares can only get the dividends out of that company. So what we would do typically is we would invest via a family trust, and then we would have a corporate beneficiary. So a company would be a beneficiary of that trust. And then each year, as that company generates income, we would distribute into that company. Now, the shares in that company are owned by the family trust. So if and when we want to pay out monies out of that company, we can pay a dividend back up into the family trust. And then if we're paying that dividend, say in 10 years' time, when your kids are adults and they're at uni and they don't have any other taxable income, we can pay it to them and not pay any tax. The other benefit is that your capital gains then accumulate in a family trust environment, which means that if you distribute to an individual, you're going to get the 50% CGT exemption. Whereas if they're in a company, you're going to pay 30%. Now, you get an imputation credit, so you might be able to eventually wind that back, but really it does give you a little bit more flexibility. So I would speak to my accountant about potentially changing the structure. Now, the way that I would deal with the existing investments is that I would leave them as is. And then if the market had some volatility, not if, when the market has volatility, because it's going to happen, and the market drops 30%, you might be able to move a large portion of the existing assets out of the company into the family trust without crystallizing or at least minimizing any capital gains tax. So I wouldn't worry about it for now, but maybe what I'd do is change how I'm investing in the future and start building that pool in the family trust. And that'll give you that'll give you the maximum amount of tax flexibility, really, still capping your rate on income that you've earned at 30% while you're working and so forth, but also still giving you flexibility around selling down and minimizing capital gains tax and all those sorts of things. But it's not a terrible outcome. I mean, if you're in a company, as I said, you get the imputation credits and then you can start paying yourself sort of regular dividends each year when you retire. So it's not the end of the world, but it's just the time value of money in terms of, and flexibility around using the family trust. Of course, your early 40s, so I would focus on that and I wouldn't be focusing too much on super at this stage. But as you get into your 50s, you then want to start probably transitioning wealth into super. And so again, that could include selling down some of that portfolio, making non-concessional contributions into super. And so hopefully by around 60, you've got most of that wealth in that super system, but nothing you need to do now. So note a property, probably an improvement on the investment structure. But again, this is not advice, and none of this is advice, of course. It's really just what you've told me and my observation, but something that you might want to talk to your accountant about. Okay, thank you to that anonymous listener, and I might just leave it there. As I said, tomorrow I'm hosting an event on YouTube, 12:30 lunchtime for 20 minutes, really quick, about lending. The link is in the show notes to register. And tomorrow, I'm going to talk about something we get asked about all the time, which is tax planning for PAYG employees. Okay, until then, bye for now. Just a few things before we wrap up, if I may. Of course, you can send me questions at questions@investopoly.com.au. But for a quicker response, feel free to add a comment on the episode's video over on YouTube. We have an Investopoly YouTube channel, and the link is in the show notes. I'm incredibly grateful for the 4.9 star rating on Apple with over 400 reviews. Thank you so much. If you can leave a review or rating, I'd love it because I'd love to get over 1,000 reviews. That's kind of my target. Keep checking the show notes for free downloads, and I include book discounts there as well. And of course, if you're interested in working with my team and I've included a web link where you can find out a little bit more about what we do and get in touch with us. And of course, until next time, bye for now.